Bloomberg Audio Studios. Podcasts, radio, news.
Hi, John.
Hi, Merryn.
Listen, we're talking in the middle of the week, and there's been a lot of fuss over the last few weeks. A lot of volatility, lots of hysteria, lots of talking about bear markets, lots of people complaining about their 401ks, etc., etc. So I have just had a quick look, and guess this for me, okay? Over the last 12 months, what's the change in the S&P 500?
Okay, it's not going to be correction territory, but call it about 6-7% down.
Actually, over 7% up.
That's
NASDAQ
nuts.
also over 7% up
The
over the
NASDAQ.
last 12 months. Yes.
That's
Yes, I'm going to double check that in real time for you, okay? Because I have access to a Bloomberg terminal. And here we are, NASDAQ Composite Index year to date. Ooh, not so good, down 12.27%. Over the last 12 months, plus 7.93%. So if you
bonkers.
are just an ordinary person
Actually.
who doesn't trade in and out all the time, isn't just directly watching, finance, telly, etc., you have 8% more money if you're invested in the US than you did 12 months ago. Can we just say this was all a great big fuss about nothing? Or is that a little simplistic?
I mean, it's a little bit simplistic, but it's not that simplistic. When you think about it, if yeah, I mean, it's a good.
I mean,
reason
what
to
it
go
tells
away
you-
and not watch your portfolio.
Yes, but also what it
obsessively.
tells you is that returns last year were absurd, and the American equity market was ludicrously expensive and ludicrously concentrated at the end of the last year, and it moved much too far, much too fast. And so even after everything that's happened so far this year, to still be up on 12 months ago tells you that what happened towards the end of last year was slightly nuts.
Yeah, oh, definitely. And I mean, this goes back to the whole point about Trump being a catalyst for shifting things out of the US towards everything else, which we knew was going to happen.
We
It's just,
did. We just couldn't time it. We just couldn't time it.
Yeah, you just needed a push, and Trump's been the push.
Yeah.
And I suspect that's still going to carry on.
Yeah,
even
I mean,
if-
it's going to come up and down. I mean, as we are speaking today, we are speaking on Wednesday, by the way, the NASDAQ is up over 4% as we speak. So, you get this huge volatility. But I think we still suspect overall that there is a great rotation underway from very expensive stocks to cheaper stocks. And we have got our main podcast this week out on Friday is with a value investor, which is really interesting in the context of this great rotation out of expensive
That's good timing.
into cheaper markets. Well, for once, yeah.
Yeah, aye. So if you do it often enough, it's bound to happen.
Yeah. And the other thing, John, that you and I have been writing about for 25 years?
25.
25 years?
Yeah.
Yeah?
Starting to sound like that Harry Enfield sketch, 25 years.
25 years.
I
I don't know that sketch. Anyway,
good.
the gold price. We're talking about the gold price. I don't know what Harry Enfield was talking about.
Sorry.
We are talking about the gold price. Up in dollar terms, 40% over the last year. 10% this month
Yes.
alone. Down a
Yeah.
little today because everything else is going up because it is the greatest portfolio of insurance of all time.
Yes.
It's moved in the opposite direction, etc. But nonetheless, it's been a phenomenal run, and we're just going to enter it into our We Told You So section.
I think so. I think that
I think
wants
so.
it.
I think we can definitely put that in.
Especially seeing as like 25 years ago, everyone said we were idiots, and you would actually have been better buying gold 25 years ago than the S&P. I mean, that is striking. And that's
Absolutely.
including reinvested dividends. So, you could have bought gold and you wouldn't even have had to reinvest the dividends because there aren't any.
You just sit there. I
Yeah.
expect that's what you did, isn't it, John?
Yeah, just a low effort. Well, I wish it's what I did. Anyway.
We don't always do what we recommend. Anyway, so here we are. Gold price up a lot, and gold price, you would expect if the chaos of the last few months continues, if we continue to have doubt about about the global monetary system, about the dollar, about incoming global recession, etc., you would think to yourself, well, the gold price will continue to go up. But I think we both slightly feel it's moved a long way very fast, and there could be a little bit of a correction in here.
Yeah, and I think there's a number of things. I mean, it was on the front cover of the FT today, and yeah, I mean, again, there's no shade on the FT, but gold's one of those, because gold's a slightly more obscure asset, you have to watch the more financial papers than the normal papers, because the gold's never going to be in the front cover of the Times, whereas the stock market might be at some point if it crashes hard enough. But as far as gold goes, if you see it on the front cover of the FT, there's probably a big contrarian indicator, and that means it's come too far too fast. Bitcoin's the same, and actually, to be fair, I remember 2017 high in Bitcoin. It was on the front cover of Money Week, which I was editing at the time. And even when I looked at the cover, I thought, that's the top of the market signal. You have become your own worst nightmare. You're a contrarian
Your
indicator.
own contrarian indicator.
Exactly. And it was. It absolutely was. So the more obscure the asset, the more you have to sort of downgrade your cover expectations. But I think for gold, sentiment-wise, that's a tell. And also you have to go with your gut when you've been watching an asset for as long as we have, and you're starting to feel a tiny bit kind of edgy. I don't think it's the mega top. I think we'd have to see a few other things happen for me to think it was the absolute top, but I think that it's probably due a breather.
But then there is a possibility that the gold miners might catch up a bit.
Yeah, I mean, you would think so. And silver well, the interesting thing was because silver's going up today, which I think is probably more to do with the fact that everyone is feeling relieved that Trump isn't going to fire, the Fed, or so he says.
So far.
Yeah, and the tariffs are a thing. Because silver, there's an element of silver that goes up alongside economic growth, and that bit's been crushed by recent events, which is one reason why it's departed so far from gold. So we might see silver catch up as well.
And you'd expect gold miners to lag a bit, wouldn't you? Because it's not just gold going up, it's gold going up and staying up that matters for a miner.
Yeah, I mean, although they are still, they're really lagging it. And I mean, I think that's partly to do with the fact that they've been such reliable capital incinerators for such a long time that people just really need to be
reliable
convinced.
Capital incinerators.
Yeah.
If you run a gold mining company, please send your email direct to John. John, you have views, don't you, on independent central banks? And we've talked about this a lot over the years. Are central banks ever genuinely independent? Should they be independent? And in fact, this whole central bank independence thing is kind of new anyway.
Yeah, it's just it's a convenient fig leaf. It was fine in the 90s and the 2000s and actually the 2010s because the central banks were doing exactly what the government wanted them to do anyway.
Keeping rates low.
Yeah, nobody felt uncomfortable about it. Everybody was happy enough about it.
Kind of should have.
And rates should have been higher while China was exporting deflation around the world. They should have leaned against that, and then we wouldn't have got the asset bubble and the house price bubble, and everyone would be less miserable now because that was a direct side effect of house prices being too high.
Central bankers also direct to John, please.
Yes.
But we had all that period where it looked like independent central banks were an absolutely fabulous idea. The great moderation, low interest rates, low inflation.
Yeah.
We had the hero central bankers, Greenspan, etc.
The plunge protection team.
The plunge protection team. And when we look back now, well, actually, you and I said at the time, of course, file under, I told you so. But when you look back now, you can say, well, this was simply a function of deflation being exported from out of China, and we don't really know if independent central banking is any good at what it's supposed to do. We don't really know if their models work. We don't really know if independent technocrats do a better job of interest rate fiddle than governments.
Yeah, and I don't think it's even that. I think it's more... They don't. It's like you've got if your independence is contingent on someone giving it to you, then you're not independent. You're just not independent. So it only lasts for as long as they're happy for it to do. And I mean, Arthur Burns in the 1970s with Richard Nixon is a classic example, and it's the same thing now. I mean, I'm sure if Trump wants to sideline or get rid of Powell, he will find a way. He doesn't just have to do it by firing them, I would have thought. I'd have thought there are other ways to get around any resistance. But the point is that whenever the kind of politics and the central bank, the politics and the technocrats bump heads, the politicians are going to win one way or another. So I think that the idea of central bank independence is really it's just a mirage. But it's like the 2% inflation target. It's worked for a wee while, and then it stops working, and we need to find something else.
Okay, we're going to stop it there, John, because I can feel your hobby horse is rising to the surface.
Oh, when are they ever not?
Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also be sure to follow me and John on X or Twitter. I'm at MerrynSW and John is John_Stepek. This episode was produced by Summer Sadi, production support and sound design by Moses Ander. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.